And what that does is it makes the market not know how to deal with a slowdown without Federal Reserve printing. And so my fear is that as we see the economy slow down due to higher interest rates, and we now have the Fed funds rate around 5%, you're going to start to see a recession kicking in probably in the second half of this year. And the kicker is going to be that inflation is unlikely to get back below 2%. It might get close. It may be 3%, 2.5%. But if the Fed won't come out and print right away, how does the market, how does the economy find its way out of a recession? It doesn't know how to anymore. In fact, you could argue that the Fed has.
Macro is not looking good. We all know that by now. But with inflation on the rise, a recession getting ready to strike like we haven't seen for years, and even regulators attacking risk assets like crypto, people need clarification on what to do and what to expect, especially new investors. And if you are one of them, you should be concerned and pay close attention to what's happening. In this video, Gareth Soloway from the InTheMoneyStocks.com and VerifiedInvestingCrypto.com will do his market analysis, including macro, stocks, gold, and obviously, Bitcoin. And this will be a scary analysis, so please watch everything carefully until the end. First, Gareth said we're getting a prolonged recession, and this is why.
A lot of that has to do with the fact is that we've been kind of addicted to Federal Reserve quantitative easing for a long period of time, right? So the market has not really experienced a recession in basically almost, 15 years. And what that does is it makes the market not know how to deal with a slowdown without Federal Reserve printing. And so my fear is that as we see the economy slow down due to higher interest rates, and we now have the Fed funds rate around 5%, you're going to start to see a recession kicking in probably in the second half of this year. And the kicker is going to be that inflation is unlikely to get back below 2%. It might get close. It may be 3%, 2.5%. But if the Fed won't come out and print right away, how does the market, how does the economy find its way out of a recession? It doesn't know how to anymore. In fact, you could argue that the Fed has broken the underlying ability for the economy to get out of a recession. So I think that's where I'm looking at it from that kind of vantage point. And I do think that that's the likely scenario here. We're facing, it's not going to be like a depression. I don't foresee that in the next couple of years. It's more like going to be a tough economy that's going to last for years. That's super hard. I mean, my guess is it's going to be at least 2 to 3 years. And then my guess is the economy will start to get worse and worse, which will then force the hand of the Fed. So even if we're at, let's say, 2.5% inflation, if you all of a sudden see 10% unemployment, the Fed will feel forced to act at that point, and then you'll get some sort of stimulus going again. The only problem is it starts the merry-go-round again, where you have then higher inflation coming in over the next few years. So, I mean, this is one of those things where it's like a drug addict. When you get addicted to it, it's very hard to get off the juice, if you will. And that's what the economy's facing now.
If this is the case, what will happen to the S&P 500, and what are his recommendations?
So I am in the camp that I do see significant downside from here. I think that investors are there's these phases when a bull market ends in the preliminary portions of a bear market where investors get very excited because they remember the good times, right? And the good times were Dogecoin and SHIB going up, hundreds of X times, maybe more. And like, AMC and GameStop and all these other ones, right? So you have these interim periods in markets where people say, oh, well, maybe we're going to get back to that. Let's buy everything that was running during that period. And you'll see those stocks pop. And we have seen that quite a bit. My bigger issue is, even though we've closed above this trend line, right? So this is a trend line that goes all the way from the all-time highs on the S&P, and you have had a bounce off of that. My bigger issue remains that we haven't even retested the pre-COVID highs here. And again, if we look at what's holding this market up. So you have the hope that the Fed pauses, but even if the Fed pauses, they're not going to lower interest rates anytime soon. Powell's made that super clear that he doesn't want to repeat the mistakes of Paul Volcker back in the 80s. So you have long-term interest rates staying probably elevated for a significant amount of time until the economy starts to go into a recession, which is kind of, you could argue that the Fed wants that. I mean, essentially, they've said they want that. So if we go into a recession, you're going to see an earnings recession. And if that happens, then valuations are still way, way too high here. What you look to do is you look to basically play defensive names right now. You play some gold plays. Some gold miners are very interesting to me down here at these levels. Like if we take a look at Newmont Mining, for instance, this had a major retrace on the daily chart where it came into all these triple support levels, right? And we can see it starting to curl back up. So if you're a fan of gold and you think gold does have some upside over the next 6 to 12 months, the miners should be a direct recipient of some upside as well. I also think that defensive plays could be something like Amgen. If you look at Amgen here, you know, the market was falling when Amgen was going up. And then ever since the market's kind of caught a bid, that's when Amgen put in its highs and it's come down to major support, actually making a little bit of a bull flag down here. So I think you look for these defensive names, these names that, again, pay a decent dividend. They do relatively well in both bull and bear markets or in recessions. And a drug stock like Amgen would definitely fit the mold there. So again, I think the key is always remember that just because it's a bear market doesn't mean that there's no opportunity. It just means you have to look a little bit harder, right? That's the key.
Gareth has been calling gold the best performing asset for 2022 and 2023 before Bitcoin explodes. This is why.
Because I think it is a fascinating chart. So we know that gold was the best performer between the S&P 500 and Bitcoin in 2022. And right now it's having a very solid year. It's not outpacing the S&P or Bitcoin yet, but my guess is it ultimately will by year end. And what we can see here is you had this beautiful rally up. You broke out above this area here on the gold daily chart. You continued up, and then we pulled back. And notice where the pullback took us. It took us right to the previous pivot point. And that's a picture-perfect chart setup, right? So basically, this was where I was looking to accumulate gold again, and that's exactly what I did. Now, again, what we've seen is a 4 or 5 day move up. Now you're getting a pause day. But looking at the bigger picture, for me, when I look at this bigger move, I am expecting gold to retrace to the all-time highs around 2070. And actually, by year end, I'd be somewhat surprised if we're not through that level. So I do see upside here, absolutely. I continue to be a big bull on gold, mainly because it offers protection in an uncertain economy, but it also offers an inflation hedge, right? So if the economy spins into recession and inflation comes down, you also have the positives of gold. Or if inflation stays high and the economy still ramps up, you still have that side of gold as well. So it's kind of like a good side on either case of the economic situation. So it definitely not necessarily just pure upside, but in the very least, this 1800 level is major support. We saw the bounce so far. So what I'm going to be looking for is you have a little bit of a trend line here, right? So we can connect these two previous pivot highs. It's around 1940 on gold. Can we go up and test that? If we do we break through? If you break through the low end of the 1800 level, it's going to bring you down to this area down here. Let me put a trend line in there so we can keep our bearings. Right. So for me, at least based on what I'm seeing, I actually think that this was a bigger breakout on gold that we're just seeing a natural retrace on. So we should ultimately continue higher. But in the off chance that I'm wrong and you do break 1800, you have more major support at 1725. Its performance during this period, right? I mean, we went from basically zero interest rates to about 5% on the 10-year, or excuse me, 4% on the 10-year, but Fed funds, again, pushing north of that level, obviously. So what we've seen is gold has held up amazingly well in spite of high interest rates. And if interest rates are getting near a peak, then you actually should see gold actually perform very, very well. And assuming at some point, like I do, that even if it takes 6 to 12 months for them to lower rates a little bit, that's going to kick in even more interest in gold. And I think there's this feeling now where, you know, people are a little bit more shaky on crypto. We don't know the regulations. We know Silvergate recently, FTX, like these other things where you had Bitcoin as an obvious alternative to gold. It's not so obvious right now. And it's pushing a lot of money towards the gold market as well, as again, people are saying, hey, listen, what's the good trusty safety hedge here? And that remains gold. So I really do think that's the key. A down dollar would be good for gold. Interest rates topping out would be good for gold, even if they don't get lowered. All of those things, again, should be a positive for the yellow metal.
And finally, looking at crypto and more specifically, Bitcoin, even though we had this bear rally, this is what Gareth sees for the near future.
So long term, I'm still very bullish. And again, important to recognize that I'm bullish on Ethereum and Bitcoin. I'm undecided on ones like Solana and Cardano. I do think they'll probably survive, but it's hard to gauge exactly how they do in the longer term. But I do think, for instance, Bitcoin longer term, very, very bullish still. Now, in the near term, though, it's important to recognize that I still see further downside. So I've been a bear since 69,000. There's bounces along the way. We've seen one of the great bear market rallies here, but what we can see here is you almost have that same M top that formed when we were at the all-time highs. Like if we go back to this chart, look at that same sort of chart pattern, which is exactly what we just created on a very smaller scale. So the question now is, we had a bear flag here, it broke down, and now we're making another bear flag, and my guess is we are headed back to 18,000 and change in the next, probably in the next month or so. So I do think you have downside on it. I still have a lower target. I still don't think Bitcoin has fully bottomed out in this cycle. And I still think that, again, too many people are bullish on Bitcoin and crypto. Like as soon as it pops, a million people come out on Twitter all like, this is the new bull cycle. Bear markets, if you look back at 99 to 2000, when the bull market ended in dot-coms, or in 2007, when the bear markets followed and finally ended, no one dared be bullish. And that's not happening in crypto yet. People are still too eager to jump on the bull bandwagon. So for me, that's a dead-on signal to be really careful with crypto over the next couple months, as we could see lower lows. In a weird way, I actually view it as a positive. I know that sounds super weird, that FTX's collapse could be a longer-term positive for Bitcoin, but I think it spurred the onset of regulation that's coming a lot faster. I think if FTX didn't happen, if Celsius didn't happen, if you had nothing going on shady in crypto, then there'd be less push to regulate it, because people, investors in crypto, wouldn't be up in arms that they're losing money left and right. And I think ultimately, for the health of cryptocurrency and the sector, you have to have transparency and regulation and all these things. So in a weird way, it's almost like a longer term positive, even though it causes short term pain.
So we can expect a prolonged recession, lower stocks, and even Bitcoin. So what should we look after, and what are Gareth's final recommendations?
So definitely this Friday, the jobs report, that's going to be the big economic data point. And then I think it's on March 22nd or so, we have the Federal Reserve next meeting on interest rates. I'm expecting a 25 basis point hike, not a 50 basis point hike, but I think they'll continue with their 25s. And then really the market will be gauging what Jerome Powell says and his guidance going forward. I think that's the key right now. Everyone's focusing on the Fed. When do they halt their hikes? When do they kind of, move their stuff? And then obviously economic data, mainly CPI, PPI numbers, as well as the jobs data this Friday, are going to be absolutely huge. So in general, I remain overall net bearish on the markets. I have more shorts out there than I have longs right now. But again, be aware that markets and bear markets can be very volatile, but I am overall short the market.
Did you enjoy this video? Want us to bring more curated content like this? Please leave a like and subscribe, and let us know in the comments below. Also, don't forget to share with your friends and family through social media. It really helps the channel and may help them as well. Thanks.